Well, hello everyone, and welcome to today's webinar. By way of introduction, my name is Hugh Wedlock, and I'm Director and CEO of the Fry Group in Singapore. It's my pleasure to welcome you to today's webinar, where we're going to be discussing the measures that were announced in the spring budget that Jeremy Hunt presented to the UK Parliament last week. Now, perhaps the budget overall was slightly less spectacular in terms of tax cuts than many Tory MPs were hoping for. But from our perspective, there were wide-ranging changes to tax rates relating to both individuals and property. There were changes to investment allowances. And finally, for the more internationally focused, there were some significant proposed changes to the taxation of non-UK domiciles. And today we're going to talk about all of those things and a little bit more. So let's have a quick look at the agenda. Here it is. The first four areas of this agenda are going to be covered by our international tax manager, who many of you will know already, and you can see on the screen there, it's Peter Webb. So Peter will be covering the first four areas, and then I'll be back to go through a few Q&A with Peter towards the end. Now, in terms of questions, the questions relating to the budget have been flooding in from our clients over the last week or so, but we always want more. So if you have any questions that you feel would like answering through the course of the presentation, please feel free to use the normal box on your Zoom screen, and we'll try and get through as many of those questions as we possibly can. So Peter has promised me that he's going to talk for around about 35 minutes, and then we'll have time for Q&A. So overall, the session today is going to last around about an hour. Before I hand over to Peter, though, I want to get your grey cells moving a little bit, or try and get your grey cells moving a little bit. And we're going to have a poll question before I do so. Now, the poll question is going to come up on your screen any second now, and there it is. And the question on the face of it is a relatively simple one. It's what do you think this budget or the budget that Jeremy Hunt outlined last week does for your own personal financial position? And you'll see three potential responses to the question. Do you think it makes it better? Is there no significant effect, or does it overall make it worse? So we'll give you a little bit of time to answer the poll question now. Any moment now, we should be getting a response through. And there it is. So 11% of you are saying that it makes your overall position better. 34% say it makes it worse, but the winner at the moment is no significant effect. And I think that's an interesting result, because I think the budget, as per what we heard last week, had a fair amount of ambiguity within. So let's hope that Peter can puncture a little bit of that ambiguity and give us slightly more definitive feel how we think this is going to affect the overall direction of travel. So with that, I'll hand over to Peter, and I'll be back for the Q&A a little bit later on. Peter, it's over to you.
Thank you, Hugh. So, yeah, very interesting. March the 6th may well have been Jeremy Hunt's last chance to change the fortunes of the Conservative Party heading into the next general election, which certainly is going to be this year. So great question is, did the Chancellor do enough to eat into the Labour Party's current lead in the polls? Another great question. So how do things stand with the economy at the moment? According to a recent report from the Office for National Statistics, the UK economy has not grown since 2022, and inflation remains high at 4%. On top of that, the UK tax burden, well, what do I mean by that? That's how much of our income and wealth we lose in tax, is the highest since the Organisation for Economic Cooperation and Development began measuring this in 2000. And that's despite the recent cut in national insurance contributions in January. With frozen tax bands and decreasing allowances, inflation's going to mean that tax burden is going to increase over the next few years, despite the further cuts to national insurance that have now been announced. I think on a more positive note, there was a really welcome announcement on increasing the relief for the high income child benefit charge and an aspiration to make that fairer. There was a somewhat surprise of an announcement on the abolition of the non-UK domicile status. We'll certainly be talking about that. A really expected announcement on a further reduction to national insurance contributions from April. That was well trailed. And we also have an announcement of a consultation on reforming inheritance tax. Now, that didn't come as any kind of a surprise either. So how was the budget? I think the polls will be the ultimate judge of whether or not Jeremy Hunt has created enough of a feel-good factor about the UK economy and the Conservative Party in particular. So we're going to move on and think about those personal tax changes. So it's worth bearing in mind that the budget speech presents proposals, and the finance bill won't make its way through the parliamentary process until maybe we get to royal assent in July or August time, and things can change in the meantime. And there were some announcements for changes from April 2025, and those proposals for April 2025 are likely to be further delayed in terms of us seeing the real detail behind those proposals. Okay, so what I've done on the next slide is to pick out some of those more significant personal tax headlines from the budget statement, which I'm going to explore in more detail over the next few slides. Personal allowances, high income benefit charge, abolition of furnished holiday letting. We've got some more property changes, reduction in national insurance. We've got a new ISA, and that's very exciting for tax people like myself. The abolition of a non-UK domicile status, maybe consultation on reforming inheritance tax. So let's get stuck into this. So allowances and tax bands are going to remain frozen. So if we can move on to that slide. So the income tax personal allowance and tax bands remain the same as they were for the 21-22 tax year, and they're going to remain the same until 27-28 under the current proposals. Freezing allowances and tax bands to set against rising taxable income over several years is a really stealthy way to make sure that we're all very likely to be going to pay more tax. Now, last time in the autumn, we had this quote from Rachel Reeves, the Shadow Chancellor, and she previously described this strategy as, I'm going to use her words, a conservative double whammy that sees frozen tax thresholds and double-digit inflation erode the real value of people's wages. Now, inflation's come down a little bit since then, but it's still there. The real squeeze here is for middle income earners, and they're the ones who are likely to see the amount of tax they pay increase significantly. As their wages increase, they're going to pay more tax at the 40% rate, the 45% tax rate. Bear in mind the recent reductions in national insurance, and we're going to talk about those in a second, will be welcomed. But bear in mind those reductions benefit those in work. If you're retired, for example, the reduction in national insurance contributions is of no benefit to you at all. Okay, so the high income benefit charge, let's move on to that. So the high income benefit charge, the threshold is going to increase to £60,000 from April 2024. That's the rate at which this charge comes in. And the taper is going to now go from £60,000 to £80,000. And that compares with the current rates of 50,000 and 60,000. At the moment, the system for the high income child benefit charge can produce some really unfair, unequitable results. I'll give you an example. So maybe you have a couple and they each earn £45,000 and they have children. That's the household income. £90,000 is earned by the household. But because they both earn below £50,000, the high income benefit charge doesn't apply. Compare that with another couple. Another couple, you have one spouse who stays perhaps childminding at home. They don't earn at all, but the other spouse is out working and they earn £60,000. Now, with the household income of £60,000 at the moment, they would face the full charge on the high income child benefit charge. So the government have announced their intention that by April 2026, the high income child benefit charge will be administered on that household, not an individual basis. Consultation on what I think is a very welcome move will begin in due course. We're going to move on and think about the abolition of furnished holiday lettings. So Jeremy Hunt announced the abolition of the furnished holiday lettings regime. There are many tax advantages for letting out short-term furnished holiday properties over those who let out properties for longer-term tenants. Now, this is one of these changes which is proposed to take effect from April 2025. And on this slide, I've listed some of those advantages that you have for furnished holiday letting over longer term letting. And I'm just going to pick up on a few of those. Capital gains tax on the sale of residential property at the moment is charged at 18% and 28%. Talk about a change to that in a minute. But for the sale of a furnished holiday letting property, you can achieve a capital gains tax rate of 10%. With furnished holiday letting, you have the ability to deduct the full cost of your mortgage interest against the profits, rather than just being restricted to a 20% tax relief. Of course, that's a benefit to you if you pay tax at 40 and 45%. Profits from furnished holiday letting allow you to make tax-advantaged pension contributions. You can't do that with long-term letting income. I think while the proposed changes represent an element of simplification, which I think will welcome the world when things get a little bit simpler for us, by aligning the tax treatment of landlords irrespective of shorter or longer lets, the overall aim is to increase year-round housing stock in high tourism areas. But I think that alignment is going to be an unwelcome shock for many, because it's a really advantageous tax regime that's being taken away. And there were some other property tax changes which we're going to talk through as well. So the taxable gain on the sale of a residential property, that's currently subject to UK capital gains tax at rates of 18% and 28%. And the rate that you pay depends on your taxable income in the year. Actually, just a quick throwaway here is, if you are selling UK residential property, please always remember that you only have 60 days to tell HM Revenue that you've done that. And in that same 60-day window, you need to pay the tax due as well. It's quite a tight reporting deadline that you have. So from 6th of April 24, that higher tax rate of 28% is going to be reduced to 24%. But the lower rate on property at 18% is going to remain unchanged. Just a quick mention that for other assets that you have, for example, some shares, you might get a tax rate on capital gains tax of 10% and 20%. Now, the capital gains tax annual exemption, that's been reduced from, well, it was £12,300 in 22-23. It's going to go down from £6,000 this year to £3,000 in 24-25, which is actually a reduction of over 75%. Now, if a capital gain arises on a disposal of a property, you're going to need to consider carefully whether you might perhaps just delay that disposal into the new 24-25 tax year to take advantage of that lower 28 to 24% reduction in the higher rate of capital gains tax that you're going to pay. But bear in mind, you've got a capital gains exemption of £6,000 this year, but only £3,000 next year. So if you're in a position where you're about to sell something and you might get a better result, perhaps if you consider 24% as your top rate of tax, I think actually there is a little bit of number crunching to do to understand whether or not you're going to benefit from that lower rate. It may even be the case that you're going to be better off using the higher capital gains tax exemption in this year. So speak to an advisor to help you with that. Multiple dwellings relief. So multiple dwellings relief, this reduces the stamp duty land tax cost of buying two or more dwellings in the same or linked transactions. I'm going to try and describe how this works. It works by adding up the total cost of the dwellings and calculating the rate of stamp duty land tax based on the average price of those dwellings. The resulting figure is then multiplied by the number of dwellings to arrive at the total stamp duty land tax charge. Don't panic if you're not following this. We're going to have a bit of an illustration in a second. But the effect of multiple dwellings relief is generally to lower the stamp duty land tax charge on buying multiple properties. Now, this multiple dwellings relief is not going to be available for any future purchases that complete on or after 1st of June 2024. Now, purchasers who exchange contracts on or before 6th of March 2024 generally remain eligible for this multiple dwellings relief, regardless of when the transaction completes. So on the next slide, I'm going to give an illustration of how the multiple dwellings relief works and the effect of withdrawing the relief. So in this example, we have 5 flats, each costing £400,000, total property value £2 million. So if you work out the multiple dwellings relief on that transaction, you're going to end up with a stamp duty land tax charge of £97,500. If you take away the multiple dwellings relief and just look at buying property worth £2 million, the stamp duty land tax charge is going to be £113,000 more. So this is a very significant relief, which is actually being taken away. Okay, thank you. We're going to move on and think about the reduction in national insurance contributions. So employee national insurance contributions are on earnings which fall between what we call the primary threshold at £12,570 and the upper earnings limit, £50,270, were reduced from 12% to 10% in January, and they're now going to be reduced to 8% from April 2024. If you're self-employed, you pay Class 4 national insurance contributions. And within those same limits, the amount of Class 4 national insurance contributions you pay are going to be reduced from 8% to 6%. And the self-employed will no longer be required to pay Class 2 national insurance contributions. But those Class 2 national insurance contributions can still be made on a voluntary basis at £3.45 a week. Now, that's much lower than the Class 3 voluntary contributions, will be unchanged next year, but £17.45 a week. So that's a lot of detail, Peter. Why are you telling me this? Well, in why you want to make voluntary national insurance contributions, why do you want to do that? You're going to need 35 years of record of making national insurance contributions to benefit from the highest rate of state pension. So you want to consider perhaps if perhaps your earnings aren't mean that you don't have to pay perhaps those class 4 national insurance contributions. Maybe you make voluntary class 2 national insurance contributions just to keep that record going. So speak to an advisor to see whether that's going to be a benefit for you. Okay, moving on, we're going to think about a new ISA allowance. So I think many commentators actually were expecting a simplification of the ISA rules in this budget, but actually no simplification, perhaps another ISA to consider. So at the moment, we have 5 different types of ISAs available to you. What are they? A cash ISA, a stocks and shares ISA, a lifetime ISA, an innovative finance ISA, and a junior ISA. And at the moment, you can choose whether you want to invest it in one type of ISA or whether you want to split your annual ISA allowance between different types. However, it's worth mentioning you can't invest more than a total of £20,000 across the different types of ISA. And once you have investments in ISAs, they're not subject to UK income tax or UK capital gains tax. So what happened in the budget? In the budget speech, Jeremy Hunt has announced a consultation on plans to launch a new British ISA, a 6th type of ISA, and that's designed to encourage UK investments. The proposal is to give investors an extra £5,000 allowance on top of the £20,000 allowance. The consultation on this closes on 6th of June, so I think watch this space for some further details on that one. Okay, deep breath, take a little drink of water. The abolition of the non-UK domiciled statement. We have seen so many questions over the last week on this. So non-doms are individuals whose permanent home or domicile is considered to be outside of the UK. The current non-dom regime is a favourable tax regime which allows non-doms who are UK resident to opt to use what we call the remittance basis of taxation. And what that means is that whilst these non-doms pay tax on their UK income and gains, they can choose to pay tax on their foreign income or gains only when they're remitted or brought into the UK. So it's advantageous. This proposed reform removes that preferential tax treatment based on domicile status for all new foreign income and gains which arise from April 2025. That's the proposal we're seeing at the moment. Now, this reform is going to abolish the remittance basis of taxation for non-UK domiciles. Now, under these proposals, and bear in mind they are proposals, for new arrivals, regardless of domicile status apparently, who have a period of 10 consecutive years of non-UK tax residence, there will be a full tax relief for the first 4 tax years of subsequent UK tax residence on foreign income and gains, non-UK income and non-UK gains. So during this 4 tax year period, your overseas income and overseas gains are not going to be subject to UK tax and can be brought into the UK without an additional tax charge. Existing tax residents who've been tax resident for fewer than 4 tax years and are eligible for the scheme will also benefit from the relief until the end of their 4th tax year of tax residence. There's a really valuable relief that we call overseas workdays relief. And this overseas workdays relief allows the value of non-UK workdays, so workdays undertaken outside of the UK, and those workdays being undertaken by non-UK domiciles, to be excluded from UK income tax, provided that various conditions are met. Now, this overseas workdays relief is going to be retained apparently, but it will be simplified. Now, once you've been UK tax resident for more than 4 UK tax years, you're going to pay UK tax on your worldwide income and gains, whether or not those overseas, those non-UK income and gains are remitted to the UK, brought into the UK, or they stay overseas. So a vast simplification of the tax rules as they stand at the moment. There are going to be some transitional reliefs for non-UK domiciles who are claiming the remittance basis of taxation under the old regime. So these are proposals at the moment. Nothing is set in stone. It's supposed that these reforms will come in on 6th of April 2025. We're desperate to see the detail behind these proposals. I think it's quite intriguing, actually. We're going to move on and think about inheritance tax. So liability to inheritance tax also depends on domicile status and location of assets. Now, under the current regime, no inheritance tax is due on non-UK assets owned by non-DOMs until perhaps they've been UK tax resident for 15 out of 20 years, when they'll become deemed to be UK domiciled. But there's a possibility that actually you won't last that long, and maybe you'll seem to have acquired a domicile of choice before you reach 15 out of 20 years of UK tax residence. So when you come to the UK, you do have a shelf life for that really valuable non-UK domicile status, which actually exempts your non-UK assets from UK inheritance tax. Now, Jeremy Hunt has announced a consultation on the best way to move inheritance tax to a residence-based regime. To provide some certainty to some affected taxpayers that the tax treatment of assets settled into a trust by non-UK domiciles prior to April 2025, the proposal is that will not be changed. So the assets that are settled into by a non-UK domicile into a non-UK trust and then non-UK assets, generally that would remain exempt from UK inheritance tax. But subject to consultation, it's proposed that the new regime will work in the following way. Regardless of domicile, there's going to be inheritance tax on worldwide assets owned outright when a person has been resident in the UK for 10 tax years. Conversely, a person will only lose their liability for inheritance tax on worldwide assets once they've been non-UK tax resident for 10 UK tax years. And that's a step change from where we are with the rules at the moment. Now, it is a consultation. We don't have the detail yet. And that consultation is going to have specific reference to some transitional provisions, the length of the residence criteria and how long you're going to remain within the scope of inheritance tax on your worldwide assets once you leave, any connecting factors other than residence, gifts with reservation of benefit, which is a big issue now with inheritance tax. Domicile elections, a very specific thing that we have now. What we call formally domiciled residents, where do they stand with these new rules? How are these trusts going to be taxed as well? Now, the comprehensive nature of this consultation means that nothing yet is certain on these reforms. Okay, we're going to move on a little bit and think about some business tax changes. I'll just see if I can get rid of my polling question, which I can't do. That's okay, I can live with that. So business tax changes, it's a little bit less of a focus for us today. We're really concentrating on the personal tax changes for you. But just to pick up on a couple of these announcements. So the VAT registration threshold is going to increase for the first time since 2017. Jeremy Hunt announced that from 1st of April, the government is increasing the VAT registration threshold from £85,000 to £90,000. Now, what that's going to do is take about 28,000 small businesses out of paying VAT altogether. And that's really welcome. The VAT regime, perhaps if you're maybe a one-man band, then the compliance needed for the VAT regime is really quite extraordinary. There's a high level of burden on you to make sure you get the reporting and the payments correctly. So I think that's actually quite a welcome move for many small businesses out there. Thinking about bigger businesses, currently there's an exclusion for leased assets from benefiting from what we call a 100% deduction against a company's corporate tax liability. This is called full expensing. So what's happened is that it's been proposed to extend full expensing to assets which are going to be leased. And that's going to be extremely beneficial to the leasing industry, given that the current main rate of corporation tax is actually 25%. Okay, moving on again. And what we're going to do now is think about some of those things that we already knew were going to change before Jeremy Hunt stood up and gave his budget speech. So these are changes we already knew were going to happen from April this year. So just to pick up on these, the national living wage will increase to £11.44. The pension savings lifetime allowance, now that's actually abolished from 6th of April 24. This year, the charges that would apply, the penalties, no longer apply, and from 6th of April 24, the lifetime allowance itself actually goes. Inheritance tax relief for agricultural property and woodlands, they're no longer going to be available for agricultural property and woodlands which are in the European Economic Area or the European Union. So that relief for woodlands and agricultural property is only going to be for UK property only. Donations to charities situated in the European Union or European Economic Area will no longer qualify for UK tax reliefs, including a really valuable inheritance tax relief. So I think, to channel my inner Theresa May, Brexit really does mean Brexit. And some more previously announced changes. So the tax-free dividend allowance last year, £2,000, this year £1,000, from April £500. The capital gains tax exemption, we've mentioned this one, last year £12,300, this year £6,000, from April £3,000. So given the reductions in the dividend allowance and capital gains tax annual exemption, carefully reviewing the tax efficiency of your investments would seem a sensible step to take. For example, just to pick on one thing, are you using all of the available tax allowances between you, maybe as a couple or even as a family? So investments in ISAs, individual savings accounts, they're free of income tax and free of capital gains tax. Given the reducing capital gains tax and dividend exemptions, you may wish to consider investing in ISAs. And from April, multiple individual savings accounts of the same type will now be allowed in a tax year. But all subscriptions must remain within that annual limit of £20,000. And bear in mind, that allowance hasn't actually changed since 2017-18. Your ISA allowance, that can't be carried forward. If you don't use it in a tax year, you lose it. It's available to UK tax residents on that use it or lose it basis. Okay, so moving on to some key takeaways. Thank you for bearing with me this far. You're almost there. So let's have a little bit of a think about how we can tie one or two of these bits and pieces together. So there are some significant changes to the taxation of non-UK domiciles which have been proposed. Bear in mind, these are proposals. We really need to watch this space to understand the detail behind what has been proposed. A consultation on reforming inheritance tax has been announced. Again, it's a consultation. We don't really have much detail around that at all. So again, watch this space. There are some really beneficial and welcome changes to the high income child benefit charge. Frozen tax allowances and tax bans mean we're likely to be paying more tax in the coming years. And final mention for that proposed abolition of the furnished holiday lettings tax regime. So at this point, I'm going to hand back to Hugh, who's going to help us with our Q&As. Hopefully you've been asking lots of questions as we've been going through.
Thanks, Peter. That's excellent. I think it's fair to say that it's a budget that's really distinguished by the sheer weight of measures involved. Really something for everyone. I think it's fair to say. So let's kick off then with a question that's kind of addressing the kind of top level as regard this budget. And taking into account the fact that the headline cut was really national insurance rather than income tax and the end of the holiday lettings regime, is it fair to say that this budget is better news for people who are still working rather than those individuals that are living solely off their asset base?
I think actually that's quite a fair comment. So the reduction in national insurance is only going to benefit you if you're in work. And then even if you are in work, that reduction in the national insurance contributions could possibly be outweighed by the increase in income tax you're going to pay if these allowances and tax bans remain the same through to 27, 28. So it's a little bit of a mixed bag. I think possibly is better news if you're in work at the moment, but actually if your income isn't coming from earnings, then no, those reductions don't help you at all.
So let's get into the detail then, and we'll start by talking about ISAs. Current ISA allowance up to £20,000 per annum, an additional 5 given the British ISA. So married couple now potentially able to contribute up to £50,000 per annum as a couple into ISA. There doesn't appear to be a lot of clarity in terms of the way that the British ISA works and what you can invest in. Any more clarity you can give us there?
Actually, not yet. I think we need to wait for that consultation to be completed to be able to then give you the real detail behind that, Hugh.
Okay. In terms of how ISAs actually work, from both an inheritance tax perspective and in terms of inheritance itself, so transferring between spouses, can you give us a bit of a reminder in terms of those two areas?
Yeah, for sure. So generally, there can be some exceptions to this, but generally spouses are able to pass assets free of inheritance tax between them when the first spouse passes on, provided that's the way the will works. The second spouse, the survivor spouse, maybe inherits that ISA. Now, generally, spouses are able to transfer assets between them on passing, and no inheritance tax is charged at that point. So it's very likely that ISA will actually pass free of inheritance tax to the surviving spouse. And the way the ISA works is that surviving spouse is then able to continue to enjoy the benefits of the assets being held in the ISA. So that ISA will continue. The freedom from income tax will continue. The freedom from capital gains tax will continue for the assets in that inherited ISA. However, what happens when that surviving spouse, the second spouse, passes on, and maybe that ISA then goes to children? Well, it's not then protected from inheritance tax unless the assets are within the available nil rate bands for inheritance tax. And perhaps the child who inherits that ISA doesn't inherit the tax benefits. So they'll receive the assets, but they don't receive an asset that's going to continue to be free of income tax or continue to be free of capital gains tax. I would just very briefly mention that with an ISA, it is actually possible to hold assets in an ISA that can be inheritance tax advantaged. So maybe there are some specific shares that you can hold in an ISA, which after they've been held for 2 years would be free of inheritance tax. And then those assets perhaps could be passed on maybe to the next generation free of inheritance tax.
No, you're thinking of shares that are attract business relief, such as types of AIM shares, etc.
Exactly, Hugh. Yes.
Okay, perfect. Thank you. Okay, so now we're on to property. Top rate of capital gains tax
Yeah.
reduced from 6th of April, and the
Yes.
end of the holiday lettings regime. If you take those two things together, do you think this is a potential opportunity to sell an investment property that perhaps you've held for quite a long time? Do you think we will see some selling on the back of this?
Whether it's the right thing to do or not, I think is a different question. But I think these are triggers that will prompt people to review their property portfolio. And yes, I think we will see some more sales. Whether or not that's the right thing to do is a very different question. And I think if you're in a position where you are going to review your property portfolio to see whether it's going to be beneficial to sell, you want to sit down with a specialist advisor to work it all through. There are so many different moving parts to owning property. There's the capital appreciation that you want to consider. There's the income tax, the stamp duty land tax, the capital gains tax, the inheritance tax. These are all considerations for owning UK property, which you do need to look at holistically.
Great, thank you. Okay, so let's get into estate planning then, and in particular the draft, well, or the considerations around moving from a domicile to a residency-based position on UK inheritance tax has drawn an awful lot of interest. And I've got a question here which covers an element of that and also goes on to consider global taxation as well. So I'll read it out for you. There are two essential elements to it. First is, how likely is it for the UK government to tax UK citizens residing abroad on their global earnings, given the recent proposal to tax non-doms in the UK? And if that were to happen, how much warning would those affected likely get? That's the first part. And Peter, what's your take on the switch to a residency-based approach to inheritance tax from next April? Are longer-term tax significantly affected by this change?
Yeah, okay. So looking at that first question, would the UK tax UK citizens on worldwide income if they're non-UK tax resident? Oh, goodness me. That's a very hard one to see. Gazing into that crystal ball, could that happen? Well, you would never rule anything out. I think it would be quite a draconian tax regime if that did actually happen. But I haven't heard any murmurings around that. So yeah, who knows? Who knows? I think it's not impossible that that would happen. And of course, the US, for example, does actually do that. That is a possibility in terms of the warning that you would get. Again, that's a little bit of an unknown. But if you look at the really significant tax changes that have been proposed in this budget statement. So an unbelievably significant reform to the taxation of domiciles and tearing up the rule book on inheritance tax and starting again almost. And we have maybe 14 months of notice on that. And if you think about that, you think about asset bases, for example, property, for example, you're not going to be able to restructure property very quickly. So you would hope that you would have time to consider the impact of any changes and make any necessary actions that you can to try and reduce that impact for you. That would be my hope. But yeah, it's such a difficult one to call. So, Hugh, I think the second part of the question was on the inheritance tax proposals, if I've understood that question correctly. Is that right?
Yeah. So it's basically your take on a switch to a residency approach, a residency-based approach to inheritance tax rather than domicile, and whether longer-term expats could be significantly affected by that change.
Yeah, I think so. This is a very, very significant change, and I think there are going to be winners and losers if these proposals are actually legislated. At the moment, when you leave the UK, if you're a UK citizen and you want to escape inheritance tax on your worldwide assets, you have this process of perhaps trying to become non-UK domiciled by choice, and that's always it's certainly achievable, but it always has a level of uncertainty because the test as to whether or not you've acquired a non-UK domicile of choice to displace your UK domicile of origin, which then gives you freedom from UK inheritance tax on non-UK assets, is a legal test called balance of probabilities. So there are always arguments to be made. And those arguments are made actually when you've passed away and you're not around to fight your corner. So there's always this level, however small it is, it could be a small level of uncertainty or a larger level of uncertainty. But if we go to a system where it's really binary and you're just counting tax years, that's going to provide much more certainty for you. 10 years, that's quite a long trail where you could still be within the realm of UK inheritance tax on worldwide assets. So for a UK citizen becoming non-resident, perhaps retiring overseas, I think that could actually be really quite beneficial. But what about a non-UK domicile who's actually become UK tax resident for 10 years? They leave the UK, and under the current rules, they could be free of UK inheritance tax very quickly indeed. Whereas under the new rules, they could still face an inheritance tax charge on their worldwide assets for a further 10 years of living overseas. So it's quite an extraordinary proposal. I think it's a real it's a fundamental shift in the tax regime for inheritance tax. I think we're all going to be very, very intrigued to see what the detailed legislation looks like behind these proposals, Hugh.
Yeah, of course, at the moment, Peter, it's a consultation,
Yeah,
uh, and
and
no
then
changes
hopefully
until
we'll
I think
get some.
available
Yeah, and then
2025. We've got a election between then and now.
yeah, yeah. So I think that consultation closes in June, and then hopefully they'll move quite quickly to some draft legislation so that because from June until April, it's not that long if these proposals do come into force.
We've had more than one person ask whether, if Labour government got in, whether they would likely enact these changes in some shape or form. We've had to give a view on that.
I think it's a very difficult one. So January, go back to January. I don't know if you remember this, but Keir Starmer said he was, I would say his word, fundamentally opposed to axing or reducing inheritance tax. And he actually said that Labour may have to consider hiking other taxes if Labour puts cutting income tax into its manifesto. So you think of other taxes, capital gains tax, inheritance tax, fuel duty, even. So I don't see at the moment that Labour are giving any signals that they're going to reduce inheritance tax. And this residence based regime, it could actually cause a reduction in that 7 billion inheritance tax take that we see each year. What I would expect Labour to do is look at these proposals very, very carefully indeed. And given their previous signalling on this, Keir Starmer saying he's fundamentally opposed to axing or reducing inheritance tax, Rachel Reeves saying that she's actually she's not for people inheriting wealth, that she wants to do something about that. I think, yeah, the Labour Party, I would expect to scrutinise inheritance tax very, very closely. And they'll look at the impact of these changes very, very closely. And if they don't achieve the aim that they want, I would expect something different under a Labour government. But that is my own view on matters.
It's a final question on estate planning and inheritance tax, I think, which is we've had more than one person ask whether there were any changes in this budget relating to trust planning specifically, and the role of trusts as an inheritance tax mitigation tool. Are you aware of anything?
Well, we do have the proposals to come, the consultation period on the reforms to inheritance tax, and it'll be very, very interesting to see how trust planning fits into that consultation. So I think that's the focus really for trust planning in this budget, is to see where it's going to fit in that new inheritance tax regime. So above and beyond that, no, there was nothing really announced on trust planning, Hugh.
Just returning to property for a second, we mentioned earlier on that there had been a reduction in the top rate of capital gains tax on the sale of investment property. We just wanted to clarify, more than one or two people have asked, obviously there is no capital gains tax on the sale of a home which is considered your principal primary residence.
Yeah, that's absolutely true. But do watch the rules around your main residence, because that relief is really valuable. It wipes out the charge to capital gains tax on the gain that you make on disposing of your main residence. But there are some quirks in that relief that you do need to be aware of. So, for example, if you've lived away from the property for a time, or you've used the property for a business, for example, or part of the property exclusively for a business, or maybe you've got a paddock that you're selling with the property, or perhaps there are separate outbuildings that go with the property as well. So the main residence relief, generally it applies, but there can be some situations where not all of the property is going to benefit from that relief. So if you've got a situation which isn't perhaps a very simple one, then do speak to an advisor to make absolutely sure you're going to benefit in full from that really valuable main residence relief.
Lisa, thank you very much. We're gonna leave the Q&A there. We managed to get through almost all of those. Thank you very much for the presentation and all your work today. Right, so it only remains for me to close the session today, and I will start that by just guiding your attention to a couple of resources that are available on the Fry Group website, namely your Guide to Understanding Domicile, and secondly, the 2024 Spring Budget Update. Both available on the website now. I in particular recommend the Spring Budget Update. It's 18 pages, but it's you know, a very good kind of roundup of everything that we've talked about today. So many of you also already know an awful lot about the Fry Group, but just as a quick reminder before we go, the Fry Group is a UK headquartered financial tax trust and estates planner. We were formed in 1898, and currently we've got offices in all of these locations with ambitions to grow those. Our mission is to help people achieve financial freedom. We appreciate that means different things to different people, but that is our mission. And if we move on, we've got some details there of our contact details in all of the jurisdictions that we currently operate. Please feel free to get in touch, even if it's just to find out a little bit more about what we do day to day. So it only remains for me to say thank you very much for joining the session today. I hope you found it useful, and we'll speak to you again soon. Thank you very much.